Welcome, financial gladiators, to the arena where we dissect the U.S. capital flows. I'm your host, and today we're diving into the labyrinth of money, power, and oh-so-sweet irony. So sit back, relax, and let's expose the puppetry behind the U.S. economy. We're talking billions, trillions, and gazillions, all wrapped up in a web of geopolitical intrigue. So grab your calculators and your tinfoil hats. We're about to go deep. Today, we're pulling back the curtain on the U.S. capital flows, its impact on the global stage, and how it's affecting you, the average Joe and Jane. We'll also give you some insider tips on how to play this rigged game. Stick around, or you might just miss the financial scoop of the decade. We're talking Wall Street secrets, international espionage, and the kind of financial advice that could make or break your piggy bank. In the 80s, U.S. capital was flowing out like teenagers sneaking out of their homes. According to a Brookings Institution paper, the U.S. sent about $100 billion abroad. Why? Because the Federal Reserve dropped interest rates like it was hot. We're talking a drop from 20% to 10% in just a few years. This was the era of Reaganomics, folks. Lower taxes, higher military spending, and oh, let's not forget the Cold War. Money was flowing into defense, into allies' pockets, and into offshore accounts faster than you could say Star Wars program. And no, I don't mean the movie.
Announcement will have an impact on the U.S. economy and your bank account. First, the Federal Reserve's interest rate policy is tied to borrowing rates. Higher mortgage rates means higher monthly payments for people buying homes now. And since the central bank began lifting rates from its pandemic-era low, mortgage applications have seen a steep decline, plunging 40% in the last year. Second, rising interest rates push up yields for savers, with some high-yield accounts now earning more than 3.5% annually. And last, Fed's ongoing battle against rising inflation. Chairman Powell reiterating the central bank will do everything in its power to fight rising costs, saying it won't stop until inflation is subdued.
We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate to return inflation to 2% over time.
Europe, the land of fine wine and confusing politics. A paper by the ECB tells us that the U.S. has been the puppet master of global capital flows. Europe's been both a puppet and a puppeteer, but that's a story for another day. The Eurozone crisis, Brexit, and the rise of nationalism have all played a role in how capital moves. It's like a soap opera, but with more numbers and fewer love triangles.
This is the 30-year yield versus its 200-day moving average. We are now trading nearly a percentage point above the 100-day moving average, which just goes to show that this momentum has really surprised all of us. Just how quickly and jarringly these yields have risen in just the last few weeks alone, Francine.
So what can you tell us about Europe? I mean, Europe's also not being spared.
This bond market rattling is going global, that is for sure. Not only are we seeing this move in the long end of the Treasury yield, but we're also seeing German bonds make some statistics as well. We had the 10-year German bond cross the 3% handle for the first time since 2011 just this morning. And then it is also hitting Asia, Japan, JGBs rising above 80 basis points for the first time in over a decade. We also saw other parts of the JGB curve rattled as well, the 5-year yield and the 30-year yield.
Now let's peel back the curtain on this global theater. The U.S., once the unchallenged maestro of this orchestra, finds its solo turning into a chorus. Europe, with its complex symphonies of fiscal policies, plays a balancing act. But enter the dragon. China, not just rising, but soaring, redefining the scales of economic power. And what's a drama without a villain? Russia, with its geopolitical chess moves, adds a touch of Cold War nostalgia. Meanwhile, the Middle East, ever the enigma, dances to the tune of oil drums, its wealth allure for both old powers and new aspirants. This isn't just about money, it's about influence, a delicate dance of diplomacy and dominance. The U.S., with its waning but still significant clout, watches as new players shuffle the deck. This global Game of Thrones isn't for the faint-hearted, it's a world where fortunes are made and lost, where nations rise and fall. The U.S., adapting to this new era, must play both kingmaker and player, navigating this ever-evolving labyrinth of power and wealth. As Frank Underwood would say, power is a lot like real estate. It's all about location, location, location. The closer you are to the money, the more power you have. In this new age, the geography of finance is as fluid as ever. and the U.S. must tread carefully to maintain its standing in this high-stakes game.
Waged in supermarkets all over this country.
From the post-war economic boom in the 1950s to its high point in the 80s, interest rates have always fluctuated with the times. But the near-zero rates of the last 15 years following the great financial crisis have hardly been the norm.
Let's take a trip down memory lane with this IMF paper. It talks about how the U.S. tried to control capital outflows back in the 60s. Spoiler alert, it was as effective as a screen door on a submarine. The IMF paper reveals how capital restrictions only led to a surge in foreign investments from $4.5 billion in 1960 to $12.5 billion in 1967. By 1968, the net outflow of U.S. private capital hit a staggering $16.5 billion, dwarfing the previous decade's figures. This was a global game of financial hide-and-seek, and the U.S. was the seeker, perpetually a step behind. The curtain falls on this act with a clear message. In the world of finance, the best-laid plans often go awry. The U.S. tried to put restrictions on capital, but money found its way through loopholes, Swiss bank accounts, and shady deals. It's like trying to hold water in a sieve. It's just not going to work. The U.S.'s attempts at control? A grand illusion in the theater of global finance.
But at the same time, if next year we're seeing 3% inflation, even if we don't have a recession, I could see the Fed pulling kind of a page from the Greenspan playbook back in 1994, when Greenspan gave back some of the rate hikes in 95 because it was essentially mission accomplished. I mean, they didn't say that at the time. Right. So, but that is the window into a glass half full ending. Of course, the glass half empty is that we do get that recession, we do get another washout, and actually microcap stocks, which is the bottom half of the Russell 2000, are making new cycle lows as we speak. So that's not a good sign, and it shows how bifurcated the market is here.
Interest rates are like the strings of a marionette, but who's pulling them? The Federal Reserve, the puppeteer of our financial lives. But remember, it's not just about interest rates, it's a whole circus of factors. Inflation, unemployment, and even presidential tweets can send shockwaves through the financial markets. It's a delicate balancing act, and one wrong move can send the economy tumbling down like a house of cards. Geopolitics, a high-stakes game where capital is the kingmaker and nations the players. The CFR source sheds light on the seismic shifts in capital flows. In the last 3 decades, we've seen the U.S. juggling its deficit with foreign capital, especially from Europe and Asia. Picture this, Europe, traditionally a bastion of economic stability, now channeling billions into the U.S. market. Meanwhile, Asia, led by China's economic ascendancy, has become a veritable force, directing substantial flows into both developed and emerging markets. In this global game, the U.S. finds itself both a player and a playfield, with foreign direct investments swinging from $59 billion in 1980 to an eye-watering $4.1 trillion in 2020. The volatility is stark. One day, capital cascades into emerging markets. The next, it recoils at the slightest whiff of geopolitical tension, much like America's abrupt exit from the Paris Agreement. So it's not just about money, it's about power. In this grand theater of finance, it's clear. Money moves not just on the whims of market forces, but on the tides of political power plays. Tax reforms, trade policies, you name it. Uncle Sam's got a whole bag of tricks, as the ECB paper points out. It's like a magician who distracts you with one hand while picking your pocket with the other. Tax cuts may seem great, but what about the deficit? Then there's the US-China trade saga, a dramatic escalation from $100 billion to over $500 billion in goods imports, turning economic policy into a high-stakes game. The trade war initiated in 2018 led to the U.S. imposing tariffs on $250 billion worth of Chinese goods. In response, China targeted $110 billion of U.S. products. This tit-for-tat tariff exchange had significant implications, not only for the two countries involved, but for the global economy as well. The tension underlined how intertwined and delicate international trade relations are, where policy decisions can ripple through global markets, affecting everything from consumer prices to international alliances. And let's not forget about trade policies that can turn allies into foes. It's a complicated web, and you need to be a spider to navigate it. Listen up, future Warren Buffetts. With all this knowledge, you can make smarter investment choices. Diversify, look into foreign markets, but always, always do your homework. Don't put all your eggs in one basket, spread it out. Invest in stocks, bonds, and maybe even some cryptocurrency if you're feeling adventurous. But remember, the higher the risk, the higher the reward or the loss. Strap in because the future is going to be a wild ride. With the current economic climate, expect more twists and turns in U.S. capital flows. And yes, that will affect your wallet. Inflation is lurking around the corner, and don't even get me started on the national debt. It's like a ticking time bomb, and you don't want to be around when it goes off. Listen up, future Warren Buffetts. With all this knowledge, you can make smarter investment choices. Diversify, look into foreign markets, but always, always do your homework. Look into commodities, real estate, and even venture capital if you've got the guts for it. But be warned, the market is a fickle mistress and she can turn on you in a heartbeat. Remember, when Uncle Sam sneezes, the world catches a cold. So keep an eye on those international interest rates and policies. They're more connected than you think. A recession in Europe or a bubble burst in China can send ripples across the pond. So diversify, diversify, diversify. So there you have it, folks. The great American money shuffle, where the house always wins and you're just trying not to go bust. If you enjoyed this financial roller coaster, don't forget to hit that subscribe button, smash that like, and drop your 2 cents in the comments below. Until next time, keep your friends close, but your money closer. And remember, in the game of financial thrones, you win or you go bankrupt. Choose wisely.